Tonight, Kurt will be manning the panel. We appreciate that. And this event really was, Kurt was the catalyst for this event. Because I know that, but we had events in the past, and I had sort of gotten out of the mood of doing that. And Kurt pressed in his way and said, I think we ought to do this. Not only was the catalyst for the event, but came up with the topic and recruited the speakers. So thank you, Kurt. Appreciate that.
Thank you, Bob. Very happy to have you all join us tonight. We have a very distinguished group of panelists to talk about growth capital. And I'd like to start off by introducing them. Alex Greeley, to my left, is a partner at Linden Capital, specializing in structured capital. Alex started his career with Oak Tree Capital and then joined Citigroup's M&A team. He later became principal at Blackstone, finally joining Chicago-based Linden Group in 2008. Alex will be speaking from the perspective of a growth capital provider with a focus on MedTech contract manufacturing and services opportunities. Structured capital is a new practice area for Linden. However, Linden has been involved with many healthcare investments over the years, including Avaline, Collagen Matrix, GCX Mounting Solutions, just to name a few. Next to Alex's left is Carter Mcnabb, a managing partner at RC Capital. Carter started his career in equity research at J.C. Bradford & Company, later moving to PE-backed Home Technology Healthcare. Carter joined RC Capital over 20 years ago and now leads the firm's healthcare investing practice. Carter will also be speaking from the perspective of a growth capital provider, but with a focus on MedTech OEM opportunities. Pioneer Surgical, Orthohelix, Catalyst Spinology, Checkpoint Surgical, and Ortholine are just a few of the companies in which RC has invested. Speaking of Ortholine, Eric Timko is chairman and CEO of Ortholine. Ortholine is an orthopedic OEM that provides surgeons with user-friendly, cost-effective systems for precise alignment during hip and knee replacement surgery. Prior to Ortholine, Eric served as CEO of Blue Belt Technologies, Neurovasics, and president of Carl Zeiss Surgical. Eric will be providing insights from the perspective of a growth capital recipient. So thank you, gentlemen, for joining us this evening. So we'd like to start off maybe with a question, just tell us a little bit about your firm and also about perhaps how you look at growth capital, what it means to you, how it might be differentiated from the type of capital that a VC firm might invest. And Eric, when we get to you, would be interested in hearing a little bit about how and when and why Ortholine decided to go out and get growth capital.
And how to spend it.
Exactly.
I love that. Yeah. Okay.
Yeah.
So first up, I'm with Linden. Linden, we are the largest dedicated healthcare investor, private equity investor in the U.S. Our private equity fund, which is on its fifth fund right now, just closed on a $3.2 billion fund. We invest across the spectrum of healthcare, touch pretty much everything except for taking anything with clinical or scientific risk. So healthcare services, pharma services, healthcare IT, importantly med devices, and distribution. The firm's been around 17 years. We have an operating partner-oriented model, so I've got 12 operating partners in addition to the deal partners that are all ex-C-suite executives, which we leverage both for sourcing investments, evaluating investments, and importantly, managing the investments and operating the portfolio companies. The fund that I am part of is the Structured Capital Fund. I co-lead that fund. We are a $355 million fund that closed last year that focuses on junior capital and growth capital into healthcare companies. So all the same types of companies that Linden invests in from a control perspective, where they're buying full control of those companies, we do on the non-control side, where we can bring to bear that same sort of healthcare expertise, operating partner-oriented model, where we have people that are real operators behind us, as partners on a non-control perspective. So from our perspective, in terms of growth capital, we're investing in businesses that are, nearing, more mature than something that would just be a typical venture capital event. We're looking for companies that are typically 25 to 30 million or more in terms of revenue, have a gross margin profile that, is attractive and profitable. We're not going to take, a risk around, one specific product line or anything like that. We want something that's diversified from a SKU or a program perspective, even if it has a little bit of customer concentration. And the real idea for us is, you should be at least at break even or kind of close to it or nearing that profitability point where, with the benefit of our operating partners, with the relationships that we can bring to bear, and importantly the capital, we can get you to that point where you are really attractive, growing, significant in scale, that it really changes your perspective from, a total valuation of the company. So that's kind of the idea behind us. Typically, and minimum investment size for us is $15 million, and above, and can scale quite a bit above that.
Great, thank you.
All right, so I'll play off that. We're RC Capital is a niche provider relative to Linden. We have raised about $1 billion over time, but through successive $200 to $300 million limited life partnerships. We're on our 7th right now, newly raised $300 million fund focused in healthcare and under the growth equity moniker. If you go back to the mid-90s, the firm was really a venture fund. As my partners and I took over the firm, we sort of matriculated to what we call growth equity, which is our own definition, and it varies a lot, and I'm sure we'll talk about that. But we invest, for this group's, I think, purposes in healthcare. We do services, IT, and device. We have a large device practice that dates back to the 2000s, where we're investing $5 to $20 million in companies that use that capital primarily for sales and marketing execution, right? A lot of the device companies we invest in are valued primarily on growth and gross margin. They're not valued on EBITDA. They're typically tuck-in acquisitions for large Fortune 2000 MedTech, and they don't care so much about EBITDA. They care about growth and gross margin, and
That's why I'm smiling.
yeah, our capital enables companies to focus on those two things. Otherwise, they'd have to, tighten the purse strings and become cash flow positive to self-fund operations. So that's the niche that we provide.
Great, thank you. Eric?
Yeah, so from my standpoint, so I've run big companies, I've run medium companies, and my sweet spot the last 8 years has been early stage to, that 20, 30, 40, 50 million in revenue type companies. And I will tell you, at that point in time, every dollar you take in is growth capital, right? It's trying to figure out how to move the needle forward. And Carter's point is the right point. I'm a sales and marketing guy at heart. I've spent my career telling stories about, successes that make impact on patients' lives because of this technology or that technology. And so as we start thinking about where we sit today and where we sit going forward, because of Carter's participation and the rest of our investors' participation, we've grown the company since I've joined from 12 million in revenue, and this year we'll do about 45 million in revenue. And again, it's using the dollars and cents very wisely, adjusting to the conditions of the marketplace, making sure that you add headcount that makes an impact, and making sure that when we're spending any dollar, whether it's Carter's or one of our other investors, I mean, we treat it like it's our own. And at the end of the day, we feel like that the model that we've built, and it's been successful, but it's got to be flexible. You've got to make changes every day, every quarter, every month, because you don't know what a COVID will do or what will transpire in the marketplace that throws you that curveball that says, my God, we gotta find a way to hunker down here for 6 months, 12 months, 2 years, because we just don't know.
Yeah, I think that's really interesting, both in the way that capital is deployed and the flexibility that you mentioned, Eric, in kind of responding to what's going on for that company in that segment at a given point in time. So with regard to, let's talk a little bit more about how capital is deployed. And I would imagine that for contract manufacturers and OEMs, it would be a little bit different in the same way that that kind of the exit criteria is different that Carter talked to. Alex and Carter, could you talk a little bit about, as you make an investment, what are the expectations around how that capital is deployed and used by the companies that you invest in?
I mean, I think, from our perspective, there has to be a clear plan about what the kind of that use of proceeds is, if it's sales and marketing, or if it's, for expansion of a line or something like that. Like, we have to have an understanding of that and what we think the ROI and the timeline to get to that is. Understanding it's on sales and marketing, sometimes it's not easy to give, a perfect timeline and visibility into that, but, having a good plan for that, I think is important.
Yeah, so very focused on our sort of equation, has a lot to do with, can you prove in a microcosm that when you put $1 in the machine, consecutive quarters come out, at some period. So we spend a lot of time with companies that have, proven their go-to-market strategy, in a region, and we're helping take it national and international, right? So we don't spend a lot of time with companies that are trying to make markets and create new paradigms in markets, but companies that have proven that it works, at least in their minds, and then we're vetting that and looking to iterate on it. So I think that's pretty much the growth equity formula. You asked about the definition of it, and we spend a lot of time on this because we're small and we, go out to our customers, our limited partners, who are pension funds and banks and endowments and stuff like that, and they have their own definitions. And it's sort of, it started, Summit really was, I think, the pioneer in growth equity, and they were investing in $2 to $3 million EBITDA positive companies that had a lot of growth potential. Couldn't lever the companies a lot because the banks weren't levering at that time. And that was a really successful model. Fast forward 25 years and funds like RC Capital are calling themselves growth equity, but half of our MedTech portfolio goes, when we invested, is sub 10 in revenue. Like, most people consider that a pretty early stage company, pretty venture-y. And for us, what we've been able to convince our LPs and what we've done over a long period of time is that our loss ratio is really small. Meaning, if it doesn't work out, some of our assumptions aren't right, there's an enterprise value to that company. When Eric joined Ortholine, that company could have been sold. It wouldn't have been a great exit, but somebody would have bought it. It's taken a lot of work and a lot of capital to build it into the enterprise it is today, and it's a highly valuable company today. But that's sort of the definitional range, because most people think, there are a lot of people that call themselves growth equity today, and there's no defined definition of it.
Right.
I mean, what does venture capital do? They're looking for growth. The way I define it is they're usually making markets and putting more money into product development.
So I guess when kind of a good rule of thumb for companies who are talking to a growth capital provider, first question is, what exactly does that mean to you, so that you know that you're on the same page with regard to expectations, again, of how that money might be spent. I think one commonality, though, that I've heard is that, coming after angel, coming after VC investment, it is, Carter, to your point, growth capital, it's looking for lower risk opportunities, kind of more sure bets of companies that, in the OEM space have already have FDA clearance, ideally would have some clinical data, have a strong customer base, and need additional funding to launch a new product, to develop sets, expand beyond what their business is currently. For contract manufacturing, how would you look at the deployment of that money? Because is it tied that directly to a particular product line, or are you looking for different characteristics that say, hey, this contract manufacturing company is really at a point where it needs growth capital and could expand the business with it?
I mean, I don't think it necessarily is tied to a particular product line, but it can be if that's like the significant growth driver. I mean, at the end of the day, what we're going to have, when we do an investment, because we're a little bit different than Carter. I think you probably have more investments. We're a little bit more concentrated in our portfolio, and probably the businesses that we're investing in are later stage. Part of our portfolio, is stuff that's backed by private equity sponsors, and part of it's stuff that's backed by founders and entrepreneurs. And in those investments, we're going to really be spending a lot of time, creating a value creation plan. Where we'll go through the different parts and really in like brutal detail of exactly what we need to do. If we need to hire a team around a specific functional area, or in the sales and marketing side we have to build out a certain region, like we'll actually like outline that stuff all out up front, in a pretty significant detailed way, so that we track against that over time. And so that's important for us, because we'll spend a lot of time and a lot of hand-holding with those companies. We'll have one of our operating partners shepherding along the whole time, making sure that you as a CEO have somebody to call for either as your as a board member, or even informally, not from the non-control side. We don't typically control the board and stuff like that, but we have significant we try to have significant say. Where you can interface with this person and use them to the extent that you find them helpful. And then, the only times we'll do these investments, since we are much more concentrated, is if we could actually feel like we have an operating partner that can help your business. If we don't feel like we can help you, like we're not going to take a bet because we like the space. We have to like the space and actually feel like there's a way we can add value through one of our operating partners.
Great. Eric, I'm curious to hear a little bit more about the success that you've had in essentially tripling the size of your business in just a few years utilizing growth capital. How was it that you saw this as an opportunity, and how did you deploy the growth capital to really drive that growth in such a short period of time?
I think the short answer is I screwed up. So when I was on the board, and Carter and a couple other board members convinced me to take the CEO role. And at that point in time, when I looked at the business, I thought we were ready for pure investment in growth capital. Like, we're going to build the commercial thing. We're going to launch this baby into a couple more applications. And the initial capital we raised, as we started to peel the onion back, we had issues galore that we needed to look at under the hood and fix so that we had sustainable growth. And going to the board and being very open and saying, look, until we get these things right, this is going to be a long slog, and so let's just invest in this to restructure, retool a little bit, and then, hopefully maintain enough capital to start the growth before putting more capital. And that's exactly what we did. And I think the fortunate thing for us, and again, it goes back to, surrounding yourself with the right people. Not only did I have a great management team, but a great board and great investors that understood, what the potential was once we got through the hurdles that we had to get through, and I think we've done that, and we've been riding a nice wave of growth, and fortunately, COVID has shifted our market in orthopedics so that the shift to the ambulatory surgery center is full on, where the big implant companies were screaming and kicking because of price erosion. We're a perfect fit for that marketplace. Our technology is easy to use, it's simple, it's efficient, it's cost effective, and we're watching our numbers, kind of have record months every month, which is a great problem to have, and hope we maintain it, not screw it up. But it's because, we were right place, right time, but after going through that kind of initial, heart-to-heart bad talk that says, let's get ready for it.
What was the talent? I mean, how many people have you hired or exchanged over the last 36, 40?
All of them.
It's a lot. It's at least 75% of the company.
Yeah, probably 75-80% of the company. Yeah, and again, I'm not knocking anybody. It's just a different mindset. I mean, I believe in A players that are gonna, really make an impact the day they hit the ground, versus prior management said, we're gonna get you in here, we're gonna train you for 6 months, and we're gonna teach you to do it our way, and then we're gonna train you 6 months to tell you about the product and how we're gonna do things, and that just doesn't work. I mean, this is an environment where it's a bloodbath.
I'll give you another example. So we have
We have a neuro catheter company, you know, catheters that feed up through your wrist or your groin up into your brain to treat stroke and aneurysm and stuff like that. And it's in Fremont, California, and they're a fast-growing company, and they do their own manufacturing. And the average, I think, the all-in cost for a rep at this company, Capel, is $462,000. That's what it costs in Fremont, California, in this space to recruit a rep that knows how to sell and can deliver the results, which we have to have. So if you didn't have growth capital and you had a great product, how are you going to hire $500,000 plus reps and 20 of them?
And it takes time to get those sales going once you hire.
Right, so it's a pretty big bet and investment to get that talent recruitment piece going. And I'm lucky because without that dynamic, I wouldn't exist, you know. But that's a tough thing to swallow as an entrepreneur, as a company owner. Even if you had great product and reason to win in your market, I got to spend $20 million just on my sales team. Now, I personally think that's unsustainable and insane, but that just is what it is in today's market.
But I think those are good examples of other ways in which to deploy growth capital for sales force expansion, for going into ASCs, for fixing internal problems that are holding you back from more effective growth. I think, Eric, you touched on flexibility, and that's something that is a little bit new to me as well, because I thought that that a company looking for investment would present to an investor a very clear plan of how that money is going to be used, and then you execute to that plan. But the flexibility component is interesting because, life happens, things don't go according to plan, you learn new things and better ways of deploying that capital. How flexible are your organizations, Alex and Carter, with regard to having changes in once you enter into a relationship with a company? What's maybe you could talk a little bit about the nature of your interactions with the companies that you invest in.
Yeah, it happens all the time. I mean, no one foresaw COVID, right? So like it was you have to adapt and change. And I mean, we have a quarterly business review process where we go through all of our portfolio companies and what's going on there. And yes, we always kind of look back at the plan that we discussed when we made the initial investment, but those things change all the time. Like it's something we have to be flexible with. Sometimes you find some positives and some negatives, and you have to kind of adapt along the way. So the value creation plan over that time frame that we work on in partnership with you, like will change and evolve as the business needs evolve, as COVID happens, as other things happen. So it's quarterly, but candidly, like more frequent than that in terms of our interaction on what's going on with business.
I've got nothing to add there. You definitely have to be a dynamic person to be, at least in the types of companies that we invest in. So many variables. That's why I think you find a lot of ex-military and sort of leadership on the athletic field people in the executive suite, because it's very hard to plan for these earlier stage companies, and they just need people that don't quit and will find a solution.
That's interesting. If you look at the portfolio of companies that you invest in, is it pretty similar from company to company how often you engage them, like a quarterly type of review, or is it more frequent? Is it every month you do a monthly review? Can you kind of describe a little bit as an investor the level of interaction and control that you have with the companies that you invest in?
Well, I'll start there. So we have, on the services side, we do control investing, and my partners there interact with the companies every day, every week. It's a much more intensive thing. On the minority side, it's a little bit inversely correlated to how well the company's doing. If they're doing well and the management team's in place, I don't do much. I don't do much for Ortholine. When they're not performing to plan and there are issues with the team, and then it's an all-encompassing thing. But we're typically on the board and part of some audit or compensation committees or
things like that. But it's really a function of what's needed.
But I think there's a huge flip side there where, having resources that are deep outside some of the boxes that we may be looking for to be able to reach out to and say, hey, here's one of our challenges. I mean, for example, we just lost a great VP of operations, and, we're in Orange County, and it's a disaster hiring people in Orange County right now. And so I reached out to our board and I said, I need you to hit all of your network. I need to find the rock star VP of ops. I got a call the next day from one of our board members, and he said, I got a guy, I vetted him through this, and this. 5 weeks later, he's on board and he's killing it, right? Because it's just word of mouth. I got this guy, I know this person, or whatever it takes to find a way to get it done. And I think that's the flip side of all this. And again, Carter and I are friends, so we interact a lot. And when it comes time to get down to brass tacks about, what can we do better? What do we need? He's very open, trust me. But on the flip side of that is, we also can interact and just have a conversation about what's going on amongst the market and other companies and things that we could be learning from.
Yeah, that's a great example of serving as a resource, your investor partner.
And no fee. They didn't charge us a fee.
These guys will have a different answer.
No, I mean,
It comes on the back end.
Oh, yeah. I'll pay somehow. I know that.
From the structured capital side, we don't charge our companies any fees or anything like that for our resources and stuff. But similar answer to you. The only thing I'd say is we work a lot with other private equity sponsors. So if there's a private equity sponsor in the ownership of the company, the interaction is probably less so than if we're dealing with a founder or entrepreneur that is looking for more partnership and active involvement in the business. So we'll be more involved in those situations. The other thing I would say is we do have a full-time human capital operation, going back to what you were talking about people needs. Like, we have a 3-person human capital team. So that team will get hit up more often just because of, especially nowadays with how competitive the talent market is. That team I think has been an asset for us. They, there's 3 people to it. One sort of deals with more of senior C-level type hires, SVPs. There's another person who's a full-time recruiter who can find you, everyone down to your hourly worker, or probably a step above your hourly worker. But she's out there in the market dealing with talent every day, and across all of our portfolio companies. So she's excellent. And then we have a full-time assessment person. Who is actually an Army-trained psychologist and does leadership assessments. So especially when we onboard a company, we do a full assessment of the management team. To the extent that we can, we at least do the CEO, CFO, COO, just to get a sense for leadership capabilities, weaknesses and stuff like that, and help you construct a plan around how to remedy that, or how to improve or how to remedy that by finding someone else to the extent that that's something you want to pursue. So we have all those capabilities in house that get hit up pretty frequently, more so necessarily than monthly or quarterly calls with the company.
So that's great. You provide money, you provide a lot of support in a lot of different ways. What are the expectations that you have for your portfolio companies? Can you make a generalization around how many years you want to grow the business and then get out, and the level of expectations you have around return on that investment?
The shorter the better. The higher the better. I made an investment in 1999 when I could dunk a volleyball, and then we exited in 2018 when I had been married and had 3 kids and couldn't touch the net. So that's one end, and you can't. We were doing a little more venture stuff back then, but sometimes you just can't force the time frames. It ended up being a great exit to a private equity firm, and it's a successful company today, so I'm proud of that. But it took forever, and our return was basically we could have invested in treasuries and sat on the beach. And then other ones I've had 11-month hold, 3x, where I just got it right, and the asset became strategic to someone else. But we typically 3 to 5 years is what we expect, and we try to put realistic milestones in place that we think will create further exit opportunity in that period of time.
And what kind of a return over that period of time are you looking for?
If you want to stay in business in our world,
3x gross, 2x net on the fund will get you there. You know? So that means if you're gonna, well, you need to be in the teens with your IRR, and you need to cash on cash needs to be around 2x for the people providing our money. What that means for an individual company can really vary. You know, if you're at the end of the fund, you know, you might be more IRR driven. You don't have to have a huge multiple, but if I could get, you know, a nice IRR in a short period of time, that can help. At the beginning, you know, you're looking for more substantive type investments. So there's some fund performance and portfolio management stuff that goes along there. But in general, if we don't think that we can reasonably make 3 times our money, it's probably not worth our time.
I see, Alex, you're nodding your head similar.
Yeah, I don't have much to add to that. You know, from a growth capitalist perspective, you know, that's what we're going to be looking for. We also deal with more mature companies where the return expectation is lower, but it's also, you know, we're taking less risk.
Yeah.
So.
Got it. Yeah, I know that one of the questions that a lot of people here tonight have is there non-dilutive growth capital possibilities out there? I mean, is that something that's a thing that is possible for smaller companies that don't want to give up equity in the business? Or is that not part of the types of investments that you guys do?
I can give a few small examples. One, there's debt, right? So debt comes along with equity, and there are lots of debt providers out there, and capital's pretty cheap, and Eric
Very cheap.
talked to that. The only options I've seen for companies that we invest in is sometimes you can get a strategic, you know, partner to come in who's interested, who will give you $5 or $10 million for development, and it's not equity dilutive, but it always comes with strings. So I don't see a lot of non-dilutive capital in my world.
Yeah, I mean, I think the similar answer for us, I mean, we're definitely not non-dilutive. We do have that option for some of the very mature companies that we deal with, but from a growth capital perspective, usually there's going to be some form of dilution. Either it's, you know, it's straight equity, or it's some form of a convertible preferred or pref plus warrant situation. We'll sometimes trade off some structure, so we'll get some form of downside protection in exchange for maybe being less dilutive than a straight equity deal. But that's, you know, it's sort of case by case.
Great.
There are also some royalty funds that will come in if you have enough momentum and they have enough visibility into your product sales. It happens a lot in pharma, but there's some on the MedTech side where they'll give you money and you just clip off a piece of your revenue. I don't know how long, forever, whatever the cost of capital is. But I don't see it. It's not super prevalent.
Yeah, I think Carter hit it. I mean, from our side, debt is piece one, and then, you know, best non-dilutive money is an acquisition.
Yeah.
Doesn't dilute at all.
Great. Well, I want to open it up to questions from the audience as well. I'm sure there's some things that we haven't covered yet that would be of interest. Anyone with a question, feel free to.
I have a question. I'm looking at Carter's.
Yeah, I'm wearing the exact same
your
thing.
BA for classical studies.
No. He's wearing the same outfit.
He's got
I'm sure that has come in handy somewhere. Can you give an example where your classical studies have come in handy?
Woo, Jeopardy. I'm good at Jeopardy and things like that. No, you know, I went to a liberal arts school, so I was, you know, a couple of classes away from a math major and an art history major, and but yeah, philosophy is what was my undergrad, and
Welcome to my world.
yeah, and it doesn't add all that much, other than I'm.
Well, Peter Thiel was a philosopher.
Yes, he was. And every once in a while, I'll run into a physician who was a classics major, and, you know, for better or for worse, we immediately hit it off, and I've actually made a few sales for our portfolio companies. That would probably be the most direct. Yeah, it's an odd background. I didn't want to be a priest. That was my only other option.
Yeah, you'd have been a good one.
Oh, yeah, it'd been a good one.
Other questions? Well, you know, we're here for, we still have the place for a while, so we have the bar, the food, and our
Awesome.
panelists are going to be here for a few minutes as well, so feel free to approach them and ask any additional questions that you may have. I want to thank you three very much for your time tonight and participating in this event.
You bet. Thank you.
Thank you. I have no idea. I just noticed that.
It's like, yeah, it's all gone.
Nice to meet you.
Yeah, nice to meet you too.
Yeah.
Yeah. Where are you from?